Edith, we're going to be talking today about essentially compliance and financial health within businesses, which is obviously really important. I know I've spoken with other people in the past about the importance of accounting records, making sure you're keeping them properly. Let's go right back to the beginning here at the building blocks of your finances within a business. Where would you say the foundations are that if you don't have something right, none of your accounting systems are going to be right?
The first thing is your profit and loss account, because that's what everyone understands.
Okay.
Once you understand your profit and loss, you can then move on to the balance sheet. But until you understand your profit and loss, balance sheet means nothing.
Right.
With a profit and loss, that's the report that everyone actually knows what a profit and loss is. Most people on the street, if you ask them a financial report, if they're going to come up with anything, it will be a profit and loss. That kind of gives you an idea of how the business is ongoing. The one that most people don't understand and is really important would be a balance sheet, because that gives you a snapshot of the health of the business at any given time.
It's a bit like the MOT of a car. At that particular time, This was the balance sheet.
It tells you exactly where you want your business to be. Well, no, not where you want it to be, where it is right this moment in time. It tells you things like who owes you what, how much you've got in the bank, who you owe where. It tells you how much you're owed by your customers. It tells you how much you owe to your suppliers. It tells you what's in your bank. And most importantly, right at the bottom, it'll tell you the actual profit for the year as well.
Brilliant. So why is the balance sheet so important?
It's really important because it just lets you know exactly what you need to be doing for your business. So if you can see that your debtors, which is the money owed to you by your customers, is really high, you know you need to be focusing on calling that money in. You know, if your suppliers is particularly high, you know you need to be starting to pay them. Or if you haven't got the cash flow for that, you need to start considering why.
So actually, you know, your P&L could potentially show you making a massive loss. However, you could be owed a lot of money that's not going to show on that P&L, but on the balance sheet, you know, you could have lost £100,000, but be owed £500,000.
You could very well be. I mean, your business isn't great if you're in a loss position of 100,000. Don't get me wrong. But if you're trying to find cash quickly, the quickest way is to be calling up your customers and getting them to pay you.
Okay. So if, as a business, you know, we're going to, you know, we want to invest, we want to grow and, you know, look at our financial health, that sort of thing. If we're going for some financial investment or that sort of thing, I think I want to see both profit and loss and balance sheet.
If they're worth their weight, then yes.
Right, okay.
No one should ever make a decision on a business based just on a profit and loss. It needs to be looking at both the profit and loss and the balance sheet and potentially a cash flow statement as well.
Okay. We can talk about cash flow statements at some point. What's the biggest compliance mistake business owners make when it comes to finance? What is the biggest mistake they make?
The biggest mistake would be not talking to us.
Yes.
That is the biggest mistake that anyone makes. They'll go and make a decision because they think it's the best route for their business, but actually they haven't considered everything.
And this is where we can, again, compare ourselves back to, you know, solicitors. People don't make, you know, legal decisions without speaking to a solicitor. Exactly. They don't get a mortgage without speaking to a mortgage advisor. And yet the amount of people, I said the statistic was 60% of businesses in the UK don't use an accountant.
That doesn't surprise me when you talk to people on the street or, you know, when you're down the pub and one of your friends finds out you're an accountant and you're finding out they've been doing their own stuff all along. You can have a 5-minute conversation with them and you can already save them £300, £400 in tax without really knowing the ins and outs of the business. So it doesn't surprise me to hear that people aren't using accountants properly. And
do you know what? You saying that is a wave of fresh air from the way other people think, because if you'd asked, you know, 90% of accountants, they'd have said that the biggest mistake people make is X is Y is Z. But actually the biggest mistake is not communicating, not talking to your professional advisor, who you pay to give you advice.
I mean, people know their business the best. So I cannot sit here and tell them how to run their business. But what I can tell them is that your decision to go out and buy that car isn't the right time. It's just not. You haven't got the cash flow in place to do so. Or actually, do you know what? Not right now. There's going to be some changes in legislation. Wait a bit. Let's just see what's going to happen first. If they need the car, then that's a different matter. If they're trying to do it for certain purposes, check with me if that's going to work.
I mean, that just kind of brings us on to cash flow. I know I've spoken before about cash flow, and I suppose this comes back to our profit and loss and balance sheet, that actually, just because money is in our bank does not mean it is ours.
Yes,
and
particularly with limited company structures. I tend to find a lot of people will come in and they've either been employed or self-employed before. They've suddenly decided to set up a company, and that might be a very good reason to do so. Now, they might come in setting up a limited company, but suddenly they're thinking the money that's sitting in there is theirs to take at any time, because it always has been. Obviously, when you're employed, the money that I receive as an employee has already been taxed at source. So that money in my bank account is mine. Very different for a limited company, because that money suddenly has to be set out for HMRC for potentially VAT, PAYE, corporation tax, all these things that won't be showing on a profit and loss. VAT and PAYE should show on your balance sheet, but your corporation tax won't, because that's got to be calculated. And everyone forgets to account for that when they're looking at their bank balance to work out what they can take. And it is actually a big pitfall of businesses.
Let's move on slightly to property and landlords. So obviously there's different ways in order to buy property, through a company, through yourself personally. Do you want to just give us a bit of a high and low of the benefits and negatives of them all? Well,
you've obviously, as you've mentioned there, you've got the company, you've got yourself, you've also got things like partnerships and stuff like that. One of the big differences between the two would be whether you can claim the mortgage interest. So if you operate it through a limited company, that mortgage interest is a tax allowable cost. But when you're an individual, it's a tax relief, and it doesn't impact you if you're a basic rate taxpayer. But as soon as you become a high rate taxpayer, it will impact you, because you'll no longer get that as a cost and potentially get 40% tax relief. You'll now only get 20%.
Right.
So that's one of the big considerations when you're looking at tax opportunities. However, it's not the be all and end all. You've got to think of your long-term plans, because if you put a property into a limited company, it's no longer your asset, it's now the company's asset, and that company's a separate legal entity to you. You may own the shares of the company, so by de facto you do own the house, but legally it's not yours, it's your limited company's. And that's an important differential to have.
So obviously you've mentioned that, just because you're the controlling shareholder of a business, it doesn't mean it's your property, and you can't just pull it out and move it.
No, because it's not as straightforward as it would be for other assets like a car. That's kind of a bit more of a paperwork exercise. When it comes to properties, there's legal ramifications, because you need to change the deeds with land registry. You need to be able to notify them for stamp duty purposes, and you might end up having to remortgage the property, because at the moment, if it's mortgaged in a limited company's name, that mortgage company will not let you move that property into your own name, because it has to be associated. So you'd have to remortgage the property as well, which often means you have to pay for more services, which often means you need to pay for more surveys and potentially revaluation costs. It can get quite expensive.
Okay. So essentially we go back to the key important thing is speak to us first.
100%.
Communicate.
Yes.
Speak to us.
And when the revenue brought in the restrictions on mortgage interest, lots of people wanted to incorporate because limited companies could be, but they wouldn't factor in the cost of stamp duty for transferring, the capital gains, then the legal ramifications of that they just went ahead and did it and got stung quite harshly for that.
Okay. I mean, we have spoken about capital gains in a previous one, which is useful, but it's people not factoring in that it isn't just as simple as transferring between names. And again, a big one is people, I've said it with the bank account before. When you're a limited company, the money in the bank account is not just yours.
No.
Even as a sole trader, we know it's not, because they still have tax liabilities and that sort of thing.
But it's their tax liabilities.
It is, whereas as a limited company, we talk about directors' loan accounts where actually people are just dipping in and they're paying for their Maldives and they're paying for their new car and they're paying for school fees and all this. Mm-hmm. And it comes to the year end and they question us as to why they've got a massive tax bill, especially if they're overdrawn on the DLA because there's not enough dividends to clear it. Mm-hmm. And suddenly it becomes our fault. Whereas actually, if they'd spoken to us, we could have explained it all and discussed it with them.
And it's monitoring their financial reporting. So they would have noticed that if they could read their balance sheet, that their director's loan account was overdrawn.
Yeah.
And again, goes back to always understanding your numbers.
We do monitor even clients where we are, doing their year ends, that sort of thing, we'll monitor it on the cloud software to make sure they're at a sensible place when it comes to dividends and that sort of thing. As well as obviously landlords who've got specific properties, they may have HMOs, which is home of multiple occupancy. Are the rules different for them?
No, HMOs are very similar to residential properties. The big difference with the HMOs, obviously, there's multiple people living in this. There's legal ramifications more so than accounting. Obviously, you want to be making sure that you're keeping an eye on tracking whether a property is profitable or not.
Yeah.
So there's certainly an impact in that respect, and you want to make sure your software's got that tracking ability. But in terms of accounts and tax, and HMO is no different to a property. They do have their own, properties in general have their own tax positionings, not dissimilar to what people currently have anyway.
So we're going to move on to relationships, and relationships between clients and their accountants.
Yeah.
And actually, some people will see an accountant as a cost rather than an investment.
Yeah.
If they're not seeing the value and that sort of thing. Obviously, you've been with us for
coming up to 8 years.
And you know that we value the relationships more than anything. So just, we've spoken earlier on about, people have to come and talk to us. I always call it the 1970s solicitor. People would never make a decision back in the 70s without, I need to speak to my solicitor or lawyer, as they would have said back then. How are we adding the value to our clients to make sure that they see that we are not a cost?
Yeah, I'll be honest, it's one of the biggest frustrations I have for people that come in the door that are coming from another accountants, that they don't see that there's a relationship there. If you don't have a relationship with your accountant, then how can you feel like you can trust them by ringing them up and asking a question? People often say, I don't want to ask a stupid question, but there's no such thing as a stupid question.
Yeah.
There's only, there's no such thing as a stupid question.
There is.
Is there?
There is.
Well, what's a stupid question?
The one you don't ask.
That's very true. And again, we can't advise if we don't know the questions. And it really, really infuriates me when I hear people saying that they've spoken to their accountant and they don't understand it. If there isn't that communication to be able to explain something in terms that someone understands, then there's no point in having the conversation.
And the relationship's not there because actually, if you don't understand, so if a client of ours doesn't understand, we actually get to the point in the meeting where we'll say, do you know what we are saying? Yeah. And I think I know the relationship's there, that they are willing to say, no, I don't. We'll go back and explain it a different way.
Exactly. If you don't feel comfortable enough to have difficult conversations with your accountant, then you shouldn't be with them. It's as simple as that, because without having the difficult conversations, you can't grow to where you want to be.
So if I look at my journey through the accountancy world, I can hand on heart sit down and say, most meetings I have with clients, 10% is to do with the accounts. Because the fact is, we have built the relationship to a place where they trust us enough to know those figures are right.
Yeah.
I don't need to interrogate my accountant about them because that's what they're good at doing. Let's just say a mechanic comes in who's got the garage. I don't go to them and ask them, have you made sure you've tightened up the flange on this? Yeah. I say to them, is that car going to be able to drive me home? They say yes. I go, right, there's your money, and off I go.
Yeah.
So the fact is, our clients don't question whether we've done calculations right, whether we thought about this, thought about that. The 90% of the meeting is about their business and how they're feeling about their business and how we could help them potentially in other areas.
Yeah, so I generally find, as you've said, sometimes I'll do it right at the start of the meeting, sometimes at the end. The thing I'm more interested in when talking to a client is how they're feeling about their business, how they're feeling about how their business is supporting what they want. And knowing exactly where they want to be helps us guide them. It helps us support, and it kind of gives that relationship.
Go back to the plan. If you haven't got a plan, you don't know where you are going.
Yeah, and worse still, you might be at point A, know you want to be at point B, but you don't know the steps to get there without that plan. And then being held accountable to that plan. That's the really important part, because how many people have a business plan that they might stick on their wall and completely ignore until the next year's accounts, and we go, well, that was your plan, what have you done with it? oh, it's been on the wall, I've looked at it, I've not changed it.
And I think, again, part of the reason some clients are intimidated or nervous around accountants is they think it is a big mystical art of accountancy. It is no different to what they do. Yeah. We are just good at this. Yeah. They are good at that.
Don't try and ask me to build a brick wall.
Absolutely.
Couldn't do it for life nor money.
Absolutely.
But ask me how to get a bank to balance, I can do it.
Absolutely. So the fact is, it is just the job we do. Mm-hmm. You know, we couldn't go into surgery and repair someone's knee.
I'd like to try.
Absolutely. But we couldn't go and repair a knee because that's not the job we do.
No, and it's not what we trained for.
Absolutely.
I mean that. I've come to the horrible realisation that I've been an accountant for half my life now. You know, we're going on waking up Monday to Friday and going and doing accounts, and I've come from a background where it's been the manual records, the books, the bags of receipts, and I've watched the industry transform to what we are now, and we're no longer needing to do all that boring work because we've got technology that can help support us.
Absolutely.
And we are there now to actually do what we used to do in the 80s. Well, not me, but what was done in the 80s. We're now there to actually help guide them again because we can trust the numbers.
Absolutely.
The numbers make sense to us. They take the time it takes to look at them. But actually where our meaning comes in for clients is understanding the numbers, transforming those numbers into something that makes sense to them, and then actually advising on how to move forwards.
Yeah. They're essentially the efficiencies of technology is meaning clients' money is better spent on things that will help them rather than just getting a bank to balance.
Yeah. Yeah, they no longer have to worry about keeping boxes and boxes of receipts in the attic for years to come because it's all saved on the cloud for them.
So essentially, rather than us spending time on the profit and loss and the balance sheet, we are there to help our clients make informed decisions on how to best run their business to make their lives better.
Yeah, and it's not always to generate the most profit. Not every client wants to make £1 million. They want to have a better work-life balance. Nobody ever leaves a business as an employee to go work for themselves, to work longer hours with less money. And that's something that as accountants we can help guide them. We've got the experience, and it might not be for myself in particular. I've never run a business, but I've learned from all the clients I deal with exactly how they operate, what pitfalls they've had, how we've supported them to get them out of that, to help guide new clients or new people in business how to get past those pitfalls without falling into them.
I mean, it's been absolutely fantastic talking these things through. So let's have your top 3 tips on why clients should be using a really good accountant.
Brilliant. So number 1 is what everyone comes to an accountant for, is tax savings.
Yeah.
Now, it's important to highlight that those tax savings can be happening in the background. We're not going to necessarily flag it to you. You know, we're doing this with your salary, we're doing this with your dividends for tax purposes. We're just doing it because that's our job. So that's your number 1, and that's the main reason most people come to an accountant. Number 2 would be to reduce your financial administrative burdens. No one wants to be spending all night till 11 o'clock at night trying to do their bookkeeping, trying to get things to balance, trying to get their VAT return sorted. You go to an accountant, we make your life easier. And finally, the third one is that support level. When you're running your own business, it's really difficult because you can feel really lonely when you're at the top of that structure. You don't know what to do. You might talk to your partner. They haven't got an idea. Come talk to your accountant because they've been in that position or they've watched other businesses be in that position and can support you through those times.
Absolutely. Edith, absolute pleasure.